Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. What's an investor to do today with all the news in the marketplace? Is it time to wait and see what happens, or is it time to get going? Well, the answer isn't as obvious as it may seem. We've got some great insight for you today on the Real Estate Guys radio program. Are you achieving everything you want in life? What if there was a time-tested way for you to get everything you've ever dreamed of? The most successful people in life set goals and keep themselves accountable. But how? The good news is that it's not rocket science. You too can learn the skills and unleash the motivation that will create success in your life. Hi, this is Robert Helms, and I'd like to personally invite you to attend Create Your Future, the 2024 Goals Retreat, January 12th to 14th in Dallas, Texas. This unique weekend event has been called phenomenal, inspirational, and life-changing by the thousands of people that have attended. Hear from some of them and find out more at goalsretreat.com. Get your life back on track, physically, spiritually, and financially. Attend the 2024 Goals Retreat on the second weekend of the new year. Visit goalsretreat.com to learn more and get on the advanced notice list. This is no dress rehearsal. Live the life you were meant to. Visit goalsretreat.com or call 888-489-7723 extension 18. That's goalsretreat.com. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms, and with me our co-host, financial strategist, Russell Gray.
Hey, Robert.
Boy, it is an interesting time to be an investor. There's so many metrics we're looking at. You've, on the show, heard Ask the Guys recently. We had Bob Frazier on the program talking about long-term trends. Meanwhile, we've got the markets reacting differently than people had supposed. Do we have a hard landing, a soft landing, or no landing at all? And as a real estate investor, we have to be concerned with broader picture economics because that's the sea we all float in. At the same time, it's got to get down to Main Street to make sense for us as investors to make a decision about what to do, which direction to go, and whether or not we take any action at all. George Gammon was on our Investors Summit this year, and he made an interesting point. He said, you don't have to feel as an investor that you always have to be doing something. And that really speaks to real estate investors. Real estate investors, especially hands-on investors of any type, people that do fix-ups, CapEx, fix and flip, any of that. It's like if I'm not doing something, then I'm sitting out. And yet the mentality is, well, sometimes you just got to wait and see. So what I want to do with today's show is give you some food for thought. And there is no right or wrong answer on this, but I'll tell you what's starting to happen. People are frozen. They're like the deer in the headlights. They're taking zero action. They're saying, I'm just going to wait and see. Well, we believe at the Real Estate Guys that rather than wait and see, it always makes better sense to think and do.
1,000%. Life rewards people who are prone to action, but foolish action can send you 100 miles an hour into a brick wall or off a cliff. So you've got to be looking out at the horizon, think about the path that you're on, the decisions you're making. Hopefully they're rooted in principles and discipline and not just emotional reactions. When you get emotional about a market, you can either get giddy and greedy and go take inordinate amount of risks because you can't see the risk because you're so busy seeing the sunshine. And the flip side of it is you can see all of the problems and not be able to move forward. Sam Zell in his book, Am I Being Too Subtle? One of my favorite quotes, I talk about it all the time, says he felt his superpower was the ability to look at the downside, see the risk, and then move forward anyway. In other words, he was able to think about the good, the bad, and the ugly, and then devise a strategy to navigate the risk, to mitigate the risk. You can't make it go away, but at least you can navigate it. You can reduce your exposure to it and take advantage of the opportunities. And the people who have the ability to act when other people can't or won't often have the marketplace more or less to themselves. And there's a reason for that, because it takes a lot more courage, it takes a lot more knowledge, it takes a lot more discipline. When you hear people talk about the idea of don't feel like you're forced to do something, it's really staying out of a desperate state. A professional salesperson, when they're dealing with a client, will always put the client's needs first. They could be down to their last dime. They can't afford to make the mortgage payment. They could be thinking, I really, really, really need to make this sale. And if that agenda comes out, if the client feels that pressure, that this is not about them, but it's about you as a salesperson, they're going to not trust you. And it's the same thing. If you're out there doing a deal because you've got a timeline, I wrote down a goal to buy 3 properties this year, come hell or high water. Well, the problem with that is if you can't find 3 investable deals and you just arbitrarily have decided 3 is your number, that's really not the criteria. You might say, I'm committed to do the work that should yield 3 deals. But if the deal doesn't come, you can't just say, oh, I see a mediocre deal, but I'm going to call it a good deal because I need a deal. That's really what we're talking about. Not withdrawing and waiting until the market proves itself, but continuing to lean in and look for what you're looking for and recognize that even when nobody else can see it, if you see it, it makes sense, go ahead and pull the trigger. A good deal is a good deal, and they're always present in every market.
Well, that's the big thing about think and do. It doesn't mean think a little and do a lot. Sometimes the thinking just has you go through all the machinations and decide, well, it's not time to pull the trigger on a deal. And it's a great point. People that are in the business of doing deals, whether that's brokers or syndicators or just folks in their own account, family offices, we have to do a deal because we have money we have to get to work. They start to compromise their principles when the market shifts. Well, if I can't get X return, I'll take X minus 2 because it's something. And at some point, that dog just doesn't hunt. Instead, I remember interviewing Kenny McElroy in about 2011 or 12, and things were slower. They had bought property on the downturn, but we hadn't seen a big upturn yet. And the whole show we ended up doing was about operational efficiency. What Ken was doing with his time then, he wasn't taking time off. He wasn't in the hammock because the market didn't give him deals. He was focusing on his thousands of units in 4 or 5 states and getting them up to operational efficiency, reducing expenses, listening to the tenants, making changes that brought profitability. And when you're in a wait and see mode, you're like an ostrich. You have your head in the ground. You're like, I don't even want to talk about it. There's just no money to be made here. In the housing market, realtors are going out of business. Mortgage people are going out of business. They're putting their head in the sand. If instead what you do is you are strategic and intentional, and as you said, Russ, take the mindset of, I'm going to do all the work necessary to be able to get into 3 deals this year. Whether or not the deals show up, I really can't control. And the flip side of that, which you were touching on, is a deal shows up when a deal shows up. And if you're not prepared, well, then a great deal doesn't get done by you because you're not in any position because you've been waiting and seeing. So I do see a lot of folks today, and we had this, 10 years ago, all the dry powder. Everyone's sitting on dry powder. And believe me, it's good to have dry powder. You want to have that. But if all you're doing is treading water, and not even treading water, because let's face it, inflation is eating away at the purchasing power of every single dollar you have, then maybe you're not getting wealthy slowly. Maybe you're losing your wealth slowly.
Well, when you're not investing in deals, what I think you should be investing in is your education and the relationships with the people that can bring you the deals. At the end of the day, it's still a relationship business. And when a great deal pops up in the marketplace, the first person to see it is probably going to do it. But if for whatever reason they can't do it, then that deal is going to go to their network. And the more valuable you are to the people who have the visibility into seeing a great deal when it pops up, the more likely you are to be near the top of the list. And so one of the things that you spend a lot of time investing in markets like this is building those relationships and making sure that you have both the financial wherewithal to move when the opportunity comes, but you also have the intellectual and emotional wherewithal and the relationships to be given a clue to when that deal shows up. And so there are many, many things you can and, my opinion, should be doing in a market like this to make sure that when those times comes, you're among the first. Because what happens is when a market begins to turn, the leaders are the ones that step in and kind of put in the bottom. And again, we're not saying this market's in free fall. We're not saying that at all. I think what people are looking at is uncertainty in the interest rate environment. Maybe not all the air has come out of the asset values yet, if you're really paying attention to the macro and understand the global economy and the impact that, say, the slowdown in China has in the United States, just like when the United States slowed way down, the impact it had around the world in 2008, then I think it's safe to say that everything that is going to go weird in the next few months hasn't happened yet. It's still in the process of playing itself out. And we're just kicking off, they say, after Labor Day. That's when the political season starts. And so we're there. There's going to be a lot of heated rhetoric. There's going to be a lot of conflicting opinions about what the best path forward is. There's going to be a lot of uncertainty about who's going to have the helm of the levers of both the Federal Reserve and what's going on in the Treasury and in Congress and in the executive branch. Nobody really knows how much government stimulus or Fed financial stimulus is or is not going to be there. They don't know what the tax law is going to be like. When you have this much uncertainty, then people are going to tend to freeze focusing on the uncertain items. But there are some things you can be certain of. People are going to get up every day and go to work because they have to feed their families. Part of their produce, if you will, the productivity of their labor, is going to go to put a roof over their head. They're going to want to live where they can have a decent quality of life, a chance to make a living, raise a family, pay their bills, and enjoy themselves a little bit. And if you're looking for markets like that and deals that are priced properly, and again, it's not like these deals are going to be out there laying on the ground like candy for you to pick up. You may have to do a lot more digging to find them. But if you do that work, when you do find that deal and you're ready to go, you go ahead and make the deal, because it's not timing that you're trying to get right. You want to be in the right market with the right asset and finance structure, capital structure, to be in for 10 or 15, 20 years. And if you get that right, a lot of things can go up and down in between. And as long as you're in a position to hold for that 10 to 15 years, real estate historically has rewarded people that play the long game.
It's one of the unique aspects of real estate as an investment. And we talk about this at our live events all the time. No one ever has to invest in a barrel of oil or a share of stock or an ounce of silver. Those are 100% discretionary. But to your point, Russ, people cannot sit out the housing market. You don't have to buy a house, but you got to rent one or live somewhere where there's going to be an exchange of value. So it's nearly impossible to sit out the real estate market. And because of that, it is a really, really unique asset. Now, we live in a time where interest rates are not at historic highs, not even close, but where we've seen the fastest increase in the shortest amount of time. And that is more emotional than it is anything else. People can't believe that a year ago, their house payment would have been half of what it is today. And that's true. And so, as we've talked about on the show, you've got all these folks who would otherwise probably be moving for that bigger house, additional kid, family change, whatever it is, except that they don't want to get rid of the 3% mortgage and replace it with a 7% mortgage. A lot of talk about what the Fed is doing and what they might do and where they might go. And it's so interesting in that if you think about the way things get priced into the market, meaning that the global brain of the market, the equities market especially, has considered all of the possibilities of where things are going and made a decision. Now, contrast that with real estate, which is a very, very slow-moving market. Because of the nature of real estate, it's liquid, but it isn't quickly liquid. Yeah, you can sell your house at the right price in any market. If you lower it enough, someone will buy it. But that's not how you get rich in real estate. Because the market moves slowly, it's different. And we come back, we'll talk about this lag effect that we hear and how that might pertain to real estate investors. Is it better to wait and see or think and do? That's what we're talking about today on the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
The Real Estate Guys are throwing a party and you're invited. Join us at the New Orleans Investment Conference, November 1st through 4th. Now in its 49th year, it's the world's longest running investment conference and features some of the biggest names in economics and investing, including James Rickards, George Gammon, Danielle DiMartino Booth, Rick Rule, and Peter Schiff. The Real Estate Guys are speaking in multiple sessions, attending lots of others, and we're hosting an invitation-only party one of the evenings for our friends and listeners, including some VIPs for you to mingle with. So make your plans to join the Real Estate Guys, the New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. That's neworleans@realestateguysradio.com. And we'll see you there.
Hello, this is Dave Lendigert, co-founder of RE/MAX International. You're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, now in our 27th year of broadcast. We're glad you decided to tune in today. If you're listening on the radio, you can replay this show by going to any of your favorite podcast outlets and looking for the Real Estate Guys radio show. We're talking today about the mentality of the market. Not the metrics of the market necessarily, but what people are thinking about it. And I'll tell you, part of our background is that we hang around people that raise money for a living. So they syndicate real estate deals. And you've probably heard this in the last few weeks during our Summer of Syndication series. We interviewed a lot of those folks, and their mission is to go out and do more and better deals by collecting expertise and capital. And so those kinds of folks have their thumb on the pulse of the mom and pop investor. Some mom and pop investors, you may be one or consider yourself one, are investing in houses and condominiums and little retail centers and those kinds of things. And other mom and pops are passively investing in private placements or syndication or group deals. And what we've noticed from listening to all these folks is that there is a reluctancy today that wasn't here even a year ago to let go of hard-earned capital. You know, that apartment deal sounds really good, but I'm not sure I want to let go of this $100,000 to invest in it. And then you've got the crowd out there that says, well, you know, treasuries are over 5, so why would I not just put my money there? And I think we can speak to that. So the first thing is that, and Russ, as our financial strategist, you can probably cover this a little better, but people believe that the treasuries are essentially risk-free.
And the reason they believe that is they're comparing it to the banks. If you're in a bank account, you are an unsecured creditor to the bank. And that means that your deposit is basically a loan to the bank. And if they go broke for whatever reason, you just get in the list of creditors that they owe money to, and you're not even in that favorable of a position once you go past that $250,000 FDIC insurance limit.
Right.
Unless it happens to be a situation like what happened with Silicon Valley Bank, where the government stepped in and said, hey, even though we don't have to, we're going to go ahead and make sure everybody's whole, because we know that if we don't, and provide that implied guarantee, then the whole banking system everybody's going to flee the banking system. And to a large degree, that's been happening anyway. People have been moving out of deposit accounts where they have that counterparty exposure, and they've been moving into treasuries where you're buying a direct IOU from the federal government, who basically backs it up with a printing press, and they have the ability to print as much money as they want. And or they're moving into custodial accounts or money market accounts. And so you see a lot of banks have been going to the Federal Reserve's emergency facility to recapitalize to compensate for the deposits they're losing as they're going out to these safer places. These are all just different ways of mitigating the risk of holding cash, and the risk that you're trying to mitigate is the counterparty risk. And so that's something that people are thinking about. And really, what we're really looking at is a marketplace that realizes that the risk game has changed a lot. And that's because interest rates have spiked up, to your earlier point, Robert, faster than they have in recent memory. That's created a lot of disruptions in the financial system. It's created a lot of downward pressure on asset prices, except for those assets that are in such high demand relative to supply, like single-family homes, that the prices remained high even though the volume of sales has stayed low. So there's some distortions in the market that people haven't seen for a while, and the old adage in sales is a confused mind won't act. So it's hard when people don't understand the new rules of the game to get them to make decisions. And so they just want to go to home base. They want to flee to the safest place. It used to be, hey, it's the safest money in the bank. Sophisticated investors with large amounts of cash know, hey, the bank isn't that safe.
Right.
Well, then where can I go? Well, then I'm going to go put the money in treasuries because I can get 5% at today's rate, be liquid, maybe every 4 weeks. I don't have the counterparty of the bank. That's pretty safe. Other people are going to gold. Gold has been very resilient. That's another form of liquid asset where you get rid of counterparty risk. In this case, you get rid of currency risk, or you could say I take currency risk because if I decide to come out of gold and go back to the dollar, the exchange rate may have changed. These are things that people are talking about. And people are trying to figure out, where can I park liquidity while I'm waiting to make a long-term investment? We talk a lot about syndication on this program. That was birthed out of 2008 when we watched the conventional capital markets fall apart. Money was not moving through the normal channels to get to fund deals on Main Street. And we looked at that and said, hey, there's going to be a big opportunity to aggregate private capital and go do the deals the institutional capital is not doing today. And that turned out to be a great call. And the last 10 years has been fantastic in syndication. Well, the capital markets are breaking again right now. Lenders are beginning to be more conservative. They're raising their criteria. It's harder to get a loan. You can still get them, but it's harder to get them because the lenders are becoming more risk averse. And so when you have a marketplace that's becoming risk averse, there's a chance for capital to come in and take those calculated risks and earn an outsized profit. And that goes back to the theme of the show today, which is think and do is better than wait and see. If you wait and see for someone to figure all that out and then you just play follow the leader, that can be okay. The problem is you're late to the party and you're late getting off the train when it's already come to a stop, right? If you can flip it over and be aware and prepared and be early to the party and be early to get off, you're in better shape. But that takes more work. That's why you listen to shows like this. That's why you attend conferences. That's why we hang out with the people we hang out with, because we want to be in that crowd of people that's aware and prepared, and we get in early and out. Again, we're not trying to time things. We're just trying to understand that these macro trends, they shift from time to time, and we've just been through a big one, and it's still happening. So you just understand that this is rooted in the capital markets, and that people with capital are trying to figure out where to put it in the short term until they can figure out what to do with it in the long term, and that at some point those long-term investments, which is what real estate investing is, are going to begin to show themselves, and the people who recognize that at the time are going to be in the best position. Meanwhile, along the way, as we said, every single day in every single market, there are always going to be good deals because real estate is not a commodity. It's always going to be unique to the neighborhood, the property owner, the capital stack, the potential of the property, the micro market right down to the neighborhood. And if you're granular at that level, working your way through the marketplace with your boots on the ground team, you have an opportunity to find those deals that other people miss. And it isn't the big money managers, you're not competing with them. You're competing with other mom and pop investors who are sitting at home on their hands because they're afraid.
What's one of our favorite things about real estate? It's not a perfect market. And there are don't-wanter sellers who will sell at a price other than today's listed price on the NASDAQ. Right? When you're a stock investor, you're taking a guess as to which direction the market is moving, either based on the technical analysis of the way stocks move or the fundamental analysis of the company and its products and its leadership and all those things. But you're buying at today's price. And that is today's price for everybody. Tomorrow's price is going to be different. Well, with real estate, it's not like that. Not every price is the same. Spending a couple decades listing and selling property in my youth, I'd sit down with a seller and I'd show them the comps, and then they would want to list their house for $50,000 or $60,000 more than any similar house had ever sold for. And that's just a matter of their opinion of their value. And doesn't make them wrong, but the likelihood of that happening wasn't high, so that would be a listing we'd elect not to take. On the other hand, you'd find opportunities where someone would say, okay, well, the market value is, 700,000, but gosh, I'd take 600 if I could be out in 30 days. Well, those kinds of things happen in real estate. So I just want to draw attention to the whole treasury idea, because that's a mainstream idea. It doesn't take any special knowledge, any special education, any of that to say I'm going to park money in treasuries. I'm not saying that's a bad thing. It's probably better than just cash in the bank account, not only from the risk perspective, but from the return. But let's talk about what the return really looks like. So inflation has been a serious challenge for the last year, maybe longer, and it likely will be into the future. And right now, all the headlines are saying, well, inflation is coming down. Well, that's not exactly what's happening. The rate of increasing inflation is not as high. So families, your tenants, are already struggling to make the payments on their credit cards. They're already struggling to put gas in their tank and food on their table, and it's getting worse every month. It's just not getting as bad this month as it did last month. And so the market has reacted as though that was great news. Yeah, look, inflation is coming down. But anyone that goes to the grocery store knows the prices aren't coming down. They're just not rising as quickly. So my point in that is, inflation is eroding your savings. So if I were to say, okay, I want to put money in short-term treasuries, and maybe that pays 5.5%. The first thing to understand is that 5.5% is taxable income. So you're not really getting 5.5%. You're getting less than that based on your tax bracket. And if the mentality is, well, at least I'm making a return, well, as soon as you look at what's happening in the market, prices in general, are you really? I think you're losing less ground. I don't think you're getting ahead.
Well, and I think the one thing to just clarify that we have to take into consideration is the people who are storing capital right now aren't really storing it as money they're going to spend on the consumer side. They're looking to invest it. And this is where inflation can be weird, because we had no inflation for a long time on the consumer price side, and everybody said, oh, there's no inflation. Yet asset prices were inflating like crazy.
Yeah.
Right now we have consumer pricing inflating at a rate that's been uncomfortable for a lot of people, while asset prices have been a little bit softer. And so people who are holding on to capital are thinking, hey, I'm going to hang on to this capital until we see where these asset prices really go. Well, that's fine when you're dealing in the macro. That's fine when you're dealing with everything in a blender. That's fine when you're dealing with concepts and averages. But again, when you go to real estate, you're talking about individual properties, individual situations. And because it affects human life and some of the pressures that are going on in people's lives right now that are based in the consumer price inflation, or now we've got all these jobs numbers revised and the job creation hasn't been as great as everybody thought it was. Real wages aren't really going up. And of course, interest expense has gone way up. Taxes are continuing to be a burden, plus the inflation burden and energy costs. You put all that in a blender, and that creates a degree of softness. Some of that softness manifests in somebody no longer being able to afford their mortgage payment. It doesn't matter how great the interest rate is, they need to sell. People get divorced every day. People die every day. People go out of business every day. And so when someone gets in a situation where they own a piece of property and they've got to get rid of it because they have one of these adverse events going on, and there's some adverse events going on, that's kind of why the mood of the market is mixed. But that means there's going to be an opportunity. And you might say, well, I don't want to be a vulture. You're not being a vulture. If somebody put their property on the market because they need to sell, it's because they need to sell. And if they need something and you bring them what they need, which is a buyer, and you give them an offer which is reasonable based on the circumstance, you're not going to buy it if it's a bad deal, but you can give them a deal that's reasonable. Now you end up with a property that makes sense for you and you solve their problem. So some people like to prey on those situations and, maybe you can make a few extra nickels if you do that, but you don't have to be a predator to be out there solving problems in the marketplace by deploying capital to help other people out of bad situations. And I guess the point that I'm making again is that even when there's all this uncertainty in the market, there's been uncertainty in the market before. This is not the first time we've had jacked up interest rates. That's happened before. This isn't the first time we've had geopolitical tensions. That's happened before. This isn't the only time we've had contentious political seasons. That's happened before. I mean, the list goes on and on and on and on, right? This is just always, this is the cycle of human existence. It goes on and on and on and on. But the people who bought property 20 years ago probably feel pretty good about it right now. The people 20 years ago who bought 20 years before that feel pretty good about that right now. I'm guessing people who buy property today 20 years are going to feel pretty good about it. You just got to make sure that you can hold on. And that's, again, the point. If you're out there in the marketplace thinking about what you have to work with and looking for the right deal and being disciplined to only pull the trigger when the right deal comes, and recognizing that whatever the external circumstances are, the fundamental need of the marketplace to use that property for whatever purpose, whether it's an industrial building, a retail, an office, a home, or some special use property, as long as that fundamental need is going to remain or be relatively strong, and you've got a finance structure you can live with, well, whatever recovery or whatever vacillations in the economy happen, then you're probably 20 years from now going to look back and go, I'm glad I did that. Versus the people who are like, I kept waiting for the market to improve. I kept waiting for somebody to come over to my house and ring the doorbell and hand me the great deal because I knew there would be great deals. Even if there was 1,000 great deals in the marketplace, nobody's coming over to your house and ringing your doorbell and telling you about it, unless you've invested the time in seasons like this to build the relationships to be at the top of somebody's call list so that when that deal shows up, you do get the call.
Think and do always trumps wait and see. We'll give you some tangible ideas of what you can be doing right now when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from December 8th to 11th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 18 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. There's all types of opportunity in Belize when it comes to real estate investing, including both long-term and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me December 8th through 11th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, December 8th through 11th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events, and I look forward to seeing you in beautiful Belize.
Hi, this is Tom Wheelwright, best-selling author of Tax-Free Wealth, and you're listening to Real Estate Guys Radio.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, right around the corner, it's The Secrets of Successful Syndication, our 2-day class on raising capital to do bigger deals or learning how to invest alongside folks doing those kinds of deals. It happens only twice a year and it's filling up nicely, but we'll make room for you. Just send an email to syndication@realestateguysradio.com. Syndication@realestateguysradio.com. We're talking today about think and do rather than wait and see. Before we get back to the program, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. As soon as you hear the question and think you might know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. Because if you're the winner, you're going to win one of my favorite books of all time. It's called Turning Pro by Stephen Pressfield. That can be yours. If you know today's real estate trivia question, last week we were talking about the state of commercial real estate financing with Anton Matley, and we asked this: where was the world's largest treehouse? Well, in Crossville, Tennessee, the world's largest treehouse had over 80 rooms, 10 floors, and took the builder 19 years to build. Landscaper Horace Burgess bought the land outside Crossville in the early 90s. Burgess became ordained as a minister and began working on the project after he said God told him to build a treehouse. It was a popular tourist destination until the fire marshal deemed it a public safety hazard. Sadly, in October of 2019, the treehouse completely burned to the ground in less than 15 minutes under unknown circumstances. Here's our real estate trivia question for this week. Which U.S. state has the most realtors? Yep, of all the states in the U.S., one has the most realtors. Now, that's not just a real estate agent or broker. A realtor is a member of the National Association of Realtors. If you know which state has the most, or you just want to take a guess, send your best guess to trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address. The first person that gets it right gets Turning Pro by Stephen Pressfield. That's today's real estate trivia question. We're talking about what is a real estate investor to do when the market is giving you conflicting signals. As Russ said, a confused mind doesn't act. Well, we think that think and do is better than wait and see. And let's face it, real estate is local. Every market is different. And it's interesting, you get this national read on the housing market, and it just never is that way. Right now, we do have some price changing in marketplaces, but some markets are going up and some markets are going down. And it has less to do with the traditional factors than it has to do with folks that are in those unique situations. Russ, before the break, you talked about people that find themselves in distressed situations and they have to sell. Well, the same thing happens on the other side. People are in a life situation where they have to buy. They're being transferred to a new city, and their company is giving them incentives to do so. Well, when they're buying a new house, they're getting a new mortgage, and you know what? They can qualify at these rates. They would rather pay less, but that's how we're seeing properties sell. We're seeing actually fewer cash sales than we have been in the past. It's interesting, less than half of the houses in America have loans on them. As real estate investors, we think we have to use leverage. That's how we magnify our returns, and that's true. But the American dream for a long time was to pay off that mortgage due. You got to burn the mortgage in front of your house, paint your door red, right? And so most properties are not encumbered. If I'm sitting on a house that I own free and clear right now, how much am I concerned about the 7% rates that my neighbor's paying to buy a house? I mean, it is going to affect my market value, but I've been in the house long enough to pay off my mortgage. I'm not too worried about the value of my house from moment to moment. Well, as real estate investors, we're a little more concerned, and we're certainly concerned with cash flow and expenses and those kinds of things. And we're going to get to some things you can actively be doing so that you feel like you are taking action, whether or not it's actually purchasing something. And I think that the big picture on real estate is that the individual markets all react differently. If we put all real estate across the country in a blender and said this is what cash flow and return are, it's not going to look that good. But the great news about real estate is we can discern where and what we invest in as real estate investors. Two of the big swipes we take are, first of all, tenant-landlord law. Half the states are more friendly to landlords, half the states are more friendly than tenants. Okay, well, it's pretty easy for me to figure that out. If I'm going to be a landlord, I want to be in a landlord-friendly state. The minute I do that, by the way, I just schlepped off a whole bunch of bad markets with bad metrics. So I've already made a better decision. Now I look at net in-migration, whether people are moving into a market, if there's more jobs being created, if people are coming in and adding vibrancy, that whittles me down to a better set of markets. And now once you're there within the market, you look for those clues. This is one of the things you can be spending your time on right now, is understanding markets. And what the housing market in the United States is doing means very, very little to you. What matters is in the 2 or 3 markets that you're either already invested in or interested in investing in, what's happening there is what's going to dictate your future.
And there's been some things happening in the macro that are driving some of those opportunities in marketplaces that you'd call maybe emerging marketplaces. And that's the repatriation of manufacturing.
Yeah.
We found out during the shutdowns that we had some dependencies on the supply chain from China, some critical supply chains, and the government and I think industry has found out that we don't want to have those dependencies anymore. Our relationship with China has deteriorated. There's a little bit more hostility. Because of that, we don't want to be as dependent upon them. That means that some of that manufacturing that had found its way overseas is finding its way back home. Meanwhile, China at one point was beginning to see itself become more prosperous. It wasn't as inexpensive to manufacture over there as it had once been. And so the shift, the ability to go overseas and save money, began to lose some of its allure. And people were looking around at other marketplaces. We also have a number of initiatives that were put in with the previous administration to entice the reshoring of jobs. And when those projects began, they began. And even though things may have changed a little bit, those projects began and they're going to come to fruition. So you see semiconductor manufacturing coming in. The situation in Taiwan has created impetus to bring semiconductor manufacturing back onshore. We obviously saw with personal protective equipment, the PPE industry, after the pandemic, we saw a lot of that stuff was being manufactured offshore. Even some pharmaceuticals were being manufactured offshore. Those are jobs that are going to be coming back to the United States, and those are marketplaces where those factories are going to get placed. And if you're paying attention, you can spot where those are and you can begin to look where those opportunities may be. And so if you wait for those things to show up and everybody sees it, well, then you're going to be a little bit late to the party. It's going to be more competitive to find the deal. It's going to be even more competitive to build the relationships to the people who have those deals. But if you take advantage of the fact that right now that people are still very much shocked at how fast the interest rates changed and wondering what's going to happen, and so caught up with all the noise in the news cycle that they have taken their eye off the fundamental of just investing in real estate based on building relationships in markets that have all the right trends in place. To your point, Robert, the right macro or the right micro environment, and then building the relationships and spending time to get to know that market so that when a deal comes along, you'll recognize it, and then just making sure that you're prepared to do it. And I think that it's wise to be prepared to act without a mortgage, even if it's private capital or maybe you have enough resources of your own. You can always opt to get a mortgage if you choose. And if interest rates go up from today, you'll be glad you got today's rate. If interest rates go down from today, you're going to be really glad because you're going to be able to replace the mortgage, and probably the decrease in interest rates is going to increase the value in the property that you bought. And if you structured it so that if interest rates don't change at all, and you can do the deal based on the financing structure you put in place, that's fine. And you always have the option to come in and pay that loan off if you choose to. So you may have the cash to do it and say, I want to keep some powder dry. So I'm only going to put down 20 or 30% instead of 100%. And yeah, my cash flow maybe isn't going to be that great, but I can always extinguish that loan if I needed to, or invest my spare capital in something that would give me some additional income to increase the cash flow without it coming from the property, right? So there's ways to do something from a portfolio perspective, and you give yourself options. And if the market really gets favorable, then you do have that capital to deploy. I think what we're saying is, I don't know that you would want to be in a situation where you walk on a good deal because it might become a great deal. If it's a good deal and you can make it work, a bird in the hand, a base hit might be better than waiting for the grand slam home run. It is really, really hard to time markets if you're looking for like an event. What is the peak? What is the bottom? What is the turning point? But if you are putting together deals that make sense, that you have options for down the road, then as long as you can stay in your current structure, if the market gets better or it gets worse, it really doesn't matter, and you can make that move if and when that moment comes.
Absolutely. And I think the other part of it is that if I'm taking the mentality that I'm going to hunker down, throw money in treasuries and gold, and wait till the sun comes out, then the best you're going to do is tread water. There is no upside in what treasuries pay. There might be a little upside in gold, but that's generally because there's unfavorable things going on in the rest of the economy. But imagine instead I found a bread and butter B-class real estate deal that was the right time in the market, and the owner needed to sell when they needed to sell, so we got a good price. Okay, so the financing is higher than necessary, but when it all shakes out, it is a similar return, 5.5%. Well, you'd argue, well, but there's, more risk than there is in treasuries, and that's true. But here's what else there is. There's upside. There's upside in price appreciation. There's upside in rents. There's a lot of upside in an apartment building that there is not in treasuries. So again, a prudent investor doesn't just do all one thing. They don't put all their eggs in one basket. But remember this, real diversity is a recipe for mediocrity. If I am too diverse, then my whole portfolio does basically nothing. So by following some of these techniques, I was just thinking, as you were talking, Russ, about what if I had the money to buy an apartment building for cash, but I didn't. I got a loan. I put the rest of the money in treasuries at 5.5%. My loan's at 7%, so I'm losing a little bit there. But what I have is that upside, and I've also got the peace of mind that if I had to, I could pay the thing off. And then if the rates change, I can lock that in. And at some point, I have the money in treasuries to go do some other project. I mean, that's how you have to think today as an investor. It's not just one thing. I'm going to put all my money in silver. No, that's probably not a good idea. Now, having said that, 2 years from now, silver might be at $35 instead of $25. And you'll think, well, I should have put all my money in silver. Well, if you guess right, that's true. But we're looking for strategies at real estate investors that let us weather storms. The fact that tenants get up every day, go to work for someone else, send a big chunk of their paycheck to us to live under an awesome roof, that is peace of mind in real estate. And the more property like that you have, the better you will weather the storm. What your interest rate is only matters when you buy a property or refinance a property. The rest of the time, it doesn't really matter. So what are some of the other things you can be doing when it's time to think and do? That's what we'll talk about when we come back. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Forbes rated Memphis the best cash flow market in the nation. And our good friend Terry Kerr at Mid-South Home Buyers has been the premier turnkey rental property provider in Memphis for over 13 years. With an A+ rating from the Better Business Bureau, Terry has renovated over 750 houses. Real Estate Guys listeners have snapped up hundreds. Discover what these satisfied investors already know. Mid-South's properties are completely renovated with a 1-year warranty and a lifelong rental guarantee. They're affordable, well-managed, and easy to own. Perfect for beginning investors and veterans alike. Get in on the action. Contact Terry and his team via email at midsouth@realestateguysradio.com.
Hi, this is Mark Skousen, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. If you lack clarity in your life and you want to have a much better tomorrow than you're having today, consider coming out to Create Your Future. The 2024 Goals Retreat happens the second weekend of the new year in Dallas, Texas. You can get all the details at our website at realestateguysradio.com. Under the tab that says events, you'll also see all the places the real estate guys are going in the coming weeks and months. We're talking about this mindset of think and do versus wait and see. And anytime there is a breather in the market, anytime that you're not actively pursuing deals because they're falling out of the trees, well, then there are some things you can be doing. And I think as we wrap up today, let's talk about some of the positive steps you can take. We talked earlier about watching your expenses. When prices are going up and rents are going up, and there's been a lot of rent escalation in the last few years, it's like, hey, this is great. You know, people that bought apartment buildings 5 years ago, as long as they got the right financing, they're doing awesome. Well, sometimes when that happens, the manager or the owner doesn't have the sharp pencil to the expenses. I'm guessing most folks, when they really take a look at their expenses at apartments and single-family houses and retail and industrial, there are some places you can improve, and that's something you can always do, is take a look at the performance and the money you're spending and where's it going and where's the bang for the buck. So that's an obvious one. But one that's maybe not as obvious is insurance. We haven't talked about insurance today, but insurance costs are rising significantly. Not only that, insurance underwriters are more difficult today than they've been in the past. So you can start early when you're thinking about acquiring a property. If I know I'm in the market for a 200-unit apartment building in fill in the blank marketplace, then getting my insurance person on the phone early and often can not only save me money, but save me time.
I think one of the other areas to take a look at is property taxes. And when you're talking about looking at a local market, yeah, the in-migration and out-migration and the business climate and all that's important, but the financial health of that particular jurisdiction matters too, because one of their sources for revenue is to go after the property owners. We've covered that a few times in the past in the state of Illinois, which has one of the highest property taxes, and when they were faced with some budget problems because of their bloated pension program, they went after property owners, and it drove a lot of people out of Illinois because of that. And so you don't want to be on that side of it. You want to be on the other side of it. And so take the time when you're underwriting a marketplace to take a look at the financial health of the taxing authority so you can gauge whether or not you think that there is a likelihood, a probability, or a small probability of them coming after you as a property owner with the property taxes. So, and the same thing with natural disasters. We've had a few unusual things happen lately. And so that causes insurance companies to make adjustments. And so the more you can understand in terms of what's going on, the way the industry is thinking, and this is where sometimes following industry trade publications, attending industry trade shows, or forming good relationships with people who do those things, who can keep you in the know, that's important. These are just little tiny competitive edges that you can have that professional investors are going to be paying attention to that amateurs won't. Obviously, if you're going to be using any form of financing, stay very tight with your mortgage professional. The bond market and the interest rates and the underwriting guidelines and the lending environment has been very volatile lately. And so you can't just assume that when you go to do a deal, the way the financing was the last time will be the way it will be this time. And I'm not just talking interest rates. You can look at what's going on in interest rates just watching any news service that tracks interest rates. But the underwriting guidelines, the LTVs, the ratios, those are the things people are going to be paying attention to. Your mortgage professional is going to be able to tell you when there are windows of opportunity or what the trends are going and what the industry is concerned about, whether they're leaning in and planning on making more capital available or whether they're beginning to restrict and make less capital available. And again, I would also invest in cultivating the option to have private capital augment it. And it's not just having private investors. Sometimes the best investor is the seller. You got the baby boomer generation. You got a lot of people that are selling properties they've held for a long time, maybe their personal homes, a place they had their business in, investment properties that they've had. And when they cash out, they're not investing anymore. They feel like, hey, maybe it's at a bit of a top, or I need to get out while the getting's good. And even though maybe it might go a little higher, I just don't want to take a chance. I need good, reliable income. I don't want to be a landlord. That owner carryback, you give them a couple points, 3 points more than a treasury, you're still sitting at a pretty competitive rate. And that can be a source of investment financing that wouldn't be available in an environment where the lending market is tightened up. So these are all things that you can begin to study and get used to and talk with people who are doing it and then look at it. And so that when you see that what's going on in the market you happen to be in, you'll be able to recognize that you have a lot more tools in your toolbox to get a deal done than maybe you're used to when money was easy.
Another great thing to be doing right now, and we've talked about it several times, but just to draw out the obvious, that is working on strengthening and even forming new relationships. Real estate investing is a relationship business, and you'll do better if you have better, stronger relationships. This is a great time to make sure that you are nurturing those relationships. In fact, I think it's a great time to consider syndication. We often talk about this idea of raising capital to do bigger deals. And you might think at first, well, if there aren't that many deals out there, it's probably the worst time to get into that business. I think it's the exact opposite of that. As we watch students take the first 6 to 9 to 12 months of their syndication career, really dialing in their business and their structure and their entities and all of that, as well as learning their chops, building their list. It's an excellent time to do that right now when maybe people's foot is a little bit closer to the brake than the gas.
1,000%. The time to get in position is before everything's going 100 miles an hour. If you've ever practiced anything, you go slow before you go fast. You practice in a safe environment before you go out in the real world. If you wait until the market's red hot and everything's booming, it's tempting to jump out and you really haven't spent the time to lay the foundation. Laying a foundation's boring. It's not exciting getting the fundamentals in place, but it's really, really important. And to your point, Robert, it's not just the financial structure and your education, but it's most definitely the relationships. And relationships, maybe of all things, take the most time to develop. And so you got to get out there. You got to meet and mingle. It's why we are so dedicated to hosting events, attending events, promoting events. We encourage people to do it. We've been doing it for 20 some odd years, going to continue to do it. There's still, thankfully, even in the age of social media and Zoom meetings and all that, you still have a lot of opportunity to get out in the real world and meet people face to face, and I encourage people to do that.
So come join us at the Secrets of Successful Syndication. It happens October 6th and 7th in Dallas, Texas. If you're listening to this at some time in the future, then just send an email to syndication@realestateguysradio.com and get the latest dates. The big message today is don't sit on your hands. Don't put your head in the sand. Instead, be strategic. Think through. Take action. It doesn't mean you always have to be buying something, but there are things you can do that will propel your real estate investing forward. Now is the time for that. Hey, we've got a great show lined up for you next week. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.